This chart shows 25 years of U.S. drilling activity, two boom-bust cycles, nearly identical peaks around 2,000 rigs, both followed by 70% collapses. The pattern repeats perfectly 2008, then 2014, except now in 2026, we're at 546 rigs, down 7.3% year over year. Yet production, well, it sits at 13.83 million barrels per day, near an all-time record. The pattern just broke. In the next 4 minutes, I'm going to tell you, you'll discover that why the third time isn't repeating history, how laterals grew from 1 mile to 3 miles in a decade, why ExxonMobil's $20 per ton proppant changes the economics of every well, and what happened to the 1,500 gas rigs that vanished while natural gas became America's largest export. I'm Mark Roach, petroleum engineer and deal maker with 30 years in this business. Some people call me an oil man. And this is FutureWise Energy, an independent analysis. The numbers today tell a story Wall Street's missing. Baker Hughes reported 546 total rigs as of January 2nd, 2026. That's 412 oil rigs and 125 gas rigs. Oil rigs, well, they're down 69 from last year. Gas rigs, they're up 22. Yet U.S. crude production at 13.83 million barrels per day for the week ending December 26. That's 250,000 barrels a day higher than even a year ago. Look at the chart. The first peak hits around 2008. Total U.S. rig count approaches 2,000. Gas rigs dominate, 1,500 of them chasing conventional plays and early shale. Oil rigs contribute maybe 400. Then July 2008 arrives. Crude hits $1.47 a barrel. 5 months later, December 2008, it collapses to $30. The financial crisis, well, it erased demand. The rig count follows, down to 1,000 by early 2009. But the industry recovers. By 2010, the shale revolution is gaining momentum. Horizontal drilling combines with hydraulic fracturing. The Bakken in North Dakota takes off. The Eagle Ford in South Texas proves the concept. The Permian Basin, left dead for multiple times over the last 100 years, roars back. By 2012, total rigs climbed back to nearly 2,000. This time the composition shifts. Oil rigs surge toward 1,500. Gas rigs collapse to 400 as natural gas prices crater from oversupply. Then comes the second crash. Mid-2014. Ouch. Oil trades above $100 a barrel. OPEC, led by Saudi Arabia, faces a choice: cut production to support prices or defend market share against surging U.S. oil shale. They chose market share. Oil plunges to $30 by early 2016. Rig count follows the same pattern, down 50% within 18 months. Oil rigs fall from 1,600 to 316 by May of 2016, the lowest since 2009. The pattern looks identical. High prices, massive drilling response, oversupply, price crash, the rig collapse, rinse and repeat. So now we're in the third cycle, except this isn't a cycle anymore, it's an evolution. Current rig count, 546 total, 73% below the 2014 peak. Oil rigs, 412, down 69 from a year ago, hitting levels not seen since September of 2021. Yet production climbed to 13.83 million barrels per day in late December 2025, just shy of an all-time high of 13.86 million barrels per day that was set in early November last year. The math stopped working. Math stopped working the old way that it did. Fewer rigs used to mean lower production, and that link severed somewhere around 2018. So what changed? Well, three things: lateral length, completion design, and proprietary technology. In 2012, a 5,000-foot lateral was cutting edge in the Permian Basin. Difficult to drill, high failure rates, it was risky. By 2015, the industry had moved to 7,500 feet. By 2018, 10,000-foot laterals became the standard, and today 15,000-foot laterals, nearly 3 miles, are routine. ExxonMobil and others are pushing beyond 20,000 feet in some areas. That's 4 miles of wellbore exposed to producing formations from a single vertical entry point. The American Petroleum Institute reports that in 2025, the average lateral length in the Midland Basin, which is a subset of the Permian Basin, was 58% longer than it was in 2015. Over 50% of wells completed in 2025 exceeded 10,500 feet laterally. The longest reached 21,276 feet. Longer laterals mean each rig drills more productive rock. A well with a 15,000-foot lateral exposed 3 times the reservoir contact compared to a 5,000-foot well. So one rig drilling a 15,000-foot lateral accomplishes what 3 rigs drilling 5,000-foot wells achieved a decade ago. But lateral length is only half the story. Completion techniques, how operators fracture and prop open the rock, they improved even faster. Proppant technology exemplifies this. For years, operators used ceramic proppants costing $500 to $1,000 per ton. Heavy, expensive, but necessary to keep these fractures open under the extreme pressures. Well, ExxonMobil changed the equation. The company developed a lightweight proppant made from petroleum coke, a low-value product from its refineries. The cost was only at $20 per ton, which is 95% cheaper than ceramic. But it's not just about the cost. The lightweight material travels farther into the fractures, and it keeps the fracture area open and increases ultimate recovery from these wells that they're using this, increases the recovery by 15 to 20% according to the early field results from over 100 wells. ExxonMobil deployed this proppant in more than 200 Permian wells through 2025, with plans to scale to 2 million tons annually. Wood Mackenzie estimates that the proppant alone accounts for roughly $1 billion of ExxonMobil's $3 billion in expected synergies from its Pioneer Natural Resources acquisition. Smaller producers, they just can't replicate this advantage. They'd pay 4 times as much for comparable material. They don't have an integrated refining asset that's generating petroleum coke to make this proppant. So this creates a bifurcated industry. Major integrated companies leveraging cross-sector advantages and independence, they're getting squeezed on the cost structure. Now, the third factor is digital technology, real-time data analytics, artificial intelligence that's guiding drilling, automated rig systems. Well, they're optimizing drilling parameters 24/7. Human operators just can't match the precision and consistency of AI systems adjusting for geologic variations, weather, and equipment performance in milliseconds. Larger operators report that AI could lower their break-even costs by more than $1 per barrel. Some see potential reductions approaching $2 a barrel. That might sound modest, but with WTI at $58 a barrel, an average break-even cost that are now estimated at $70, every dollar does matter. So now let's address the vanishing gas rigs. In 2008, 1,500 gas rigs were operating in the U.S. Today, 125 gas rigs are operating. That's a 92% collapse. Now, this isn't failure, it's market transformation. Natural gas production didn't collapse with rig counts. In fact, U.S. natural gas output exceeded 108 billion cubic feet per day in 2025. That's nearly 4% higher year over year. The EIA projects that 2025, when all the data comes in, will mark another record-breaking year for gas production. How? Well, the same efficiency revolution, longer laterals, better completions, associated gas from oil wells in the Permian Basin. Also, the Marcellus Shale in Pennsylvania produces more than 4 trillion cubic feet annually, with a fraction of the rigs that operate during this peak back in 2011, 2012. But here's the strategic shift. Natural gas stopped being a domestic-only commodity. The U.S. became the world's largest liquefied natural gas, LNG, exporter in 2025, exceeding 100 million metric tons for the first time in history. Current U.S. LNG export capacity is about almost 106 million metric tons per year. Under construction, well, there's another 76 million metric tons concentrated around the Gulf Coast. By 2029, North American LNG export capacity could reach almost 29 billion cubic feet per day. That's up from just over 11.4 billion cubic feet per day at the start of 2024. That's more than doubling in 5 years. Gas rig counts are climbing again. We're up 22 rigs year over year to 125, the highest since July 2023. But they're drilling in different places for different reasons. The Haynesville Shale in Louisiana and Texas is the focus. Deep, high-pressure wells with massive gas reserves positioned close to the Gulf Coast. To these LNG terminals, JERA, J-E-R-A, Japan's largest power generator, just paid $1.5 billion for Haynesville Basin assets producing 500 million cubic feet per day, securing a 10-year supply contract for LNG exports to Asia. That's not a domestic play. That's a global energy trade restructuring. So where does this go? Well, the EIA forecasts U.S. crude oil production will average 13.5 million barrels a day in 2026. That's down 100,000 barrels per day from last year. Well, that would end a 4-year streak of rising output. And analysts are citing lower prices, WTI averaging around $58 a barrel in early January 2026, down 21% from a year ago, and reduced drilling activity, in spite of the drill baby drill mantra. But forecasts miss the latent capacity embedded in the system. Drilled but uncompleted wells, DUCs, DUCs. Well, these drilled and uncompleted wells, they sit across shale basins waiting for higher prices or improved service availability to hold down cost of bringing that production online. So basically, they're drilling these wells, letting them sit there until the price rises or until it becomes cheap enough, with the infrastructure getting nearer the new well, to bring that production online. So these behind pipe zones, as they're called, they exist in existing wellbores. They're not related to that rig count, and they can be recompleted at any time to access any of the bypassed reservoirs that were bypassed in the original well. So I happen to have learned this lesson the hard way back in the 1990s, forecasting Gulf of Mexico production. Our models underestimated reserves from recompletions, which ended up accounting for roughly half of all offshore gas well completions by 1996. Now, today's shadow supply, these DUCs, deferred laterals, recompletion candidates, they could deliver substantial incremental production when economics do permit. Break-even costs tell another story. Enverus Intelligence Research estimates that current average break-even for new shale wells is $70 a barrel. Well, with WTI at $58, new drilling economics, they're looking pretty challenged. But Enverus also projects break-even costs will rise to $95 per barrel by 2035 as operators exhaust the best acreage, the Tier 1 acreage in the Permian, and move to less productive, more expensive locations. So that timeline matters. The next decade will separate companies with proprietary advantages in cost, like ExxonMobil's petroleum coke proppant, from those that are operating the way we all used to on standard industry technology. The former, well, they can maintain profitability at $60 oil. The latter, well, they need $75 oil or higher in the Permian. Consolidation accelerates this divergence. Roughly 40 major operators now control the vast majority of U.S. production after the merger wave of 2024 through 2025. SM Energy and Civitas Resources announced a $12.8 billion all-stock merger. Chord Energy acquired Williston Basin assets. ExxonMobil absorbed Pioneer. Chevron pursued Hess. These aren't just scale plays, they're technology and acreage consolidations. The survivors will be companies with the best rock, the lowest structures, the lowest cost structures, and the operational discipline to generate free cash flow at $50 oil. The chart shows two boom-bust cycles that looked identical. The third time, well, it broke the pattern. Rig counts fell 73% from peak, yet production stayed near record highs. That's not luck. That's industrial evolution, technology compounding faster than depletion. But evolution doesn't mean immunity. Lower prices will constrain activity. Break-even costs will rise as prime acreage depletes. The easy barrels are gone. What remains is a test of who adapted, who innovated, and who has the last balance sheet to outlast volatility. The survivors won't be the ones drilling the most. They'll be the ones extracting the most value per dollar spent. I'm Mark Roach. This is FutureWise Energy.